Hello everybody, welcome to July 2024 REITs portfolio update and a review. The last update I gave was in June, and this month I'm sounding a lot more upbeat and cheerful because I do see glimmer of hopes emerging on the horizon for REITs and the overall portfolio of mine, which has been suffering really bad. So let me just share with you some of my insights. This was the performance of my REITs portfolio and the overall portfolio as of June. And the REITs portfolowering was down 12%, overall down 4.5%. And in the space of 1 month, quite a fair bit of things happened. Of course, triggered by the lowering of the CPI all over the world actually, and the increasing dovishness of certain Fed officials. We're not looking at not just one cut, I think. It might even be two cuts. So that is something very useful. And the REITs portfolio as of June or as of July, which is 1 month later, was down 8%. So quite a fair bit better than last month. In just 1 month actually. And the overall portfolio was down, is still down 2.5%, which is still in the red, but nonetheless it is much better than before. My overall expectations for the portfolio is still not high, but I'll be very happy if I can get back to maybe flat for the REITs portfolio and overall positive for the overall portfolio by the end of this year, which might be possible if the Fed cuts 2 times and sounds more optimistic. But nonetheless, I'm still quite convinced that rates will stay higher for longer, and therefore I am positioning my REITs portfolio and the overall portfolio to take advantage of my views. So this is the things that I've done for the past 1 month, and this was the weightage of the different components of my REITs portfolio as of June 2024. The first thing I did was to sell more Star Hill Global at 49.5 cents. And with that, I lowered the proportion of Star Hill Global in my REITs portfolio. As of the June review, I looked at this number and I thought this number was way too high, especially given my view that rates will be higher for longer. I think over the next 2 years, rates will not go back to 2%. So therefore, the bottom line of everything will just get impacted by the higher for longer rates. So therefore, 18% is a bit too high. Although it still looks quite undervalued and giving a good yield, but nonetheless, it's I think prudent to just scale back my REITs percentage. And I channeled a whole bunch of the capital to Shenzong, which is something that I think has very good growth potential. I see three things in its favor actually. The first of all, I think the government and Singapore is going to allocate a lot more land to new HDB estates. We're going to have new HDB estates in Tengah, in Paya Lebar, and all over Singapore. And because Shenzong is very strong in the heartlands, therefore I think it's going to benefit massively from this more new HDB estates. And don't remember, and don't forget, for each new town that emerges, you not just have the opportunity for one outlet, you have actually multiple outlet opportunities. You just need a cluster of HDB estates and you have potential for another new store opening. And the second factor for Shenzong in its favor is actually the expansion in China, in Kunming. I think the overall China operations are profitable, and therefore they are looking at more store openings and therefore more top line growth, which hopefully trickles down to the bottom line. The third thing in Shenzong's favor, I think, is the ecosystem that it is benefiting from Shopee. Because I've been spending some time on Shopee actually, and I found that you can actually accumulate coins in Shopee using the cashback vouchers, and you can actually spend the coins in Shenzong and therefore offsetting some of the purchases. I think being part of the whole ecosystem with Shopee, which is a fast-growing e-commerce giant in Singapore and all over Southeast Asia, is going to benefit them quite massively actually. So I think with these three factors, I'm quite confident that Shenzong is going to grow quite well. In fact, if you look at the recent half announcements, the earnings are up 7%, and the dividend also went up. So I think this is not just a fast-growing company, but the dividend increments will be quite substantial going forward. Not to mention the fact that they have a whole bunch of cash pile. So I'm more comfortable with this position, and I've accumulated quite a fair bit actually at 1.49. So with the sale of the stake in Star Hill Global, let's see at the revised weightage of the various components of my REITs portfolio. and also comment on the recent result announcement. I thought FEHT and Escort performed in line with my expectations. DPU was kind of stable, not down massively. I think it's just stable, and they're gonna benefit from the tourism as well. In fact, there were some analysts saying that Escort will benefit from the Olympics and their effects. So nonetheless, I think these two positions I'm still happy to keep as it is and just collect dividends. Ames APEC I thought was very impressive. The rental reversions were higher. AIs are looking well. Balance sheet looks very strong, and I'm getting a very good yield on this stuff. If you notice, I've not sold anything for this stuff for the past 2.5 years, and the overall position is actually very respectable. If not for Ames APEC, I think the overall REITs portfolio will be down a lot more. So Cleans, I've reduced my stake previously. I have not touching it. ESR, well, it's continued to be a disappointment. It's expanding, even like recently, it's talking about buying more stuff in Japan and in Singapore in Tuas. And I think with that will come another set of preferential offerings, and therefore I think the stock price is going to take a hammering again. This is of course a heavy disappointment for me. I don't think I'm going to participate in the preferential offerings though, unless the price is really a steep discount, forcing me to take a stake. Otherwise, if the offering is around 25 to 30 cents, I don't think I'm putting in my capital anymore. Like, this door is shut for this REIT for me. MIT, I think, is still respectable. They managed to find some new tenants for the data centers in the US. Although the business park seems to be suffering a bit of from an oversupply and somewhat of pessimism, but nonetheless, I think financials are still positive, and data centers are still a bright spot over the world, especially now that they have a third growth engine in Japan. So things should be not bad. Star Hill, I've reduced my stake, as I mentioned. CLCT results are, well, not great, but I think everything is already penciled in already. FLCT, I'm surprised though. The share price performance has been a complete surprise. If you look at the price chart, I was quite surprised actually. People just kept hammering this stuff down to 92 cents, 93 cents. Yeah, I don't know why actually. ECB is dovish. Logistics seems quite okay. Also, I'm not very sure why people are dumping this stuff off. But you see there's a little pop-up as well. So the price action is actually quite puzzling. So now it's like a $1. But at one stage, it actually went to 92, 93 cents, which was really puzzling. I read, well, it's just 1.5%, and I don't think I'm going to do anything much. I think Berlin is still quite a decent asset, but repositioning will take time, and, well, there's no hurry to jump in anyways. So the revised weightage would be like this, so somewhat same, or just up 0.5%. 4.9% here. ESR 4.8, MIT 18.2, and Star Hill is the one with the biggest component change because of my sale over here. It went from 18% to 13%. Alright, so I sold 5% for this stuff. CLCT remains roughly the same, FLCT the same, Escort the same, IREIT the same. All the same because I didn't do anything for them, and I just continued to collect dividends. And the REITs portfolio right now, as a total percentage of my portfolio, is 37%, down from 38%. I'm quite surprised actually, because in June, my REITs portfolio was 38% of my portfolio. So when I sold my stake in Star Hill Global, I thought this number would drop to like maybe 33, 34%, but nonetheless it's 37%. But that's because the REITs portfolio have jumped up quite a fair bit. So therefore, the capital gains from the REITs portfolio managed to offset a whole bunch of the valuation decrement because of my sale. So now it is still 37% of my portfolio, simply because of the REITs recovery over the past 1 month. So this is all the highlights that I want to share for my REITs portfolio. Just to summarize again, I reduced my REITs portfolio, channel a whole bunch of money into other companies which have a decent dividend policy with a nice balance sheet without debt. This is on top of my rotation out into UOB earlier this year, which was a fortunate move actually. So I'll continue to do that as well going forward, mainly using the dividends and the cash that I receive from the dividends to diversify my portfolio even further into a more diversified portfolio, and hopefully get this percentage of REITs as a percentage of my portfolio to me down to like 33 or 34% by the end of this year. So that's my sharing for this session. Hope you guys have a very enjoyable July so far as well, and merry returns for the rest of the year.